Welcome everybody to our 15th episode of our Bay Area Housing Market Town Hall. And today, again, I'm sure you guys are here because you needed to do some tax planning for 2020. So I hope that today we are going to be able to share a lot of information with you. All right. So again, our Bay Area Housing Market Town Hall, we have been starting since March 25th. When we started, it was like the start of our COVID and shelter in place. Unfortunately, now 9 months later, we are going back to shelter in place, but this hasn't stopped. We're still providing a lot of education directly to you, to our real estate industry, to our consumers. So I'm very excited that we actually have this opportunity to do that for you. And, 2020 has been like a crazy year. I know a lot of people are probably going to say that I don't want to have this, spend another 2020. I want this to be over with. I want, things to get better. And unfortunately, life is just not always smooth, right? We always have some obstacles in our life, but those obstacles is your own story, and you get to write the ending. This is according to Brené Brown. I absolutely love what she said. All right, so I thought today would be a great time to invite my good friend, Tim Tikalsky, who is a CPA and a CCIM. He is a tax principal at Sensiba San Filippo. And just to give you a little background about Tim, Tim has almost 40 years of accounting experience, and he's a tax principal, specializes in tax planning, compliance, consulting, and also he has extensive experience in handling engagement with multi-state and foreign operations. Tim is also a leader in South San Francisco real estate and construction industry group. He's frequent contributor to professional and technical publications and events such as San Francisco Business Times, and also appeared several times as a guest on the Gary Allen on Business radio show hosted by KNBR 680. As a matter of fact, we are both serving on the NorCal CCIM chapter as the leadership team, and he is going to be playing his guitar and singing at our next Tuesday's virtual installation and 50th anniversary ceremony. So thank you so much, Tim, for being here. And I'll let you start this. We have a lot of questions right now, and I'm sure we're going to start having more and more questions flooding in. But let me just start from asking you. So what do you think about now that Joe Biden is our, foreseeable president-elect? What do you think our tax law is going to change? Is it going to be more favorable or less favorable for real estate investors and property owners?
Well, before I jump into that, let me congratulate you on your book, Helen. That's like the best kept secret in the world. That's the first I had heard of it. And I love your philosophy. So I'm a golfer, and I'm sure that other golfers can appreciate this. I always tell people that it's not how you play your good shots, it's how you recover from your bad shots that really says what kind of a player you are. So hopefully we are going to be recovering from our bad shots in 2020 and keeping the game going. So I appreciate that and looking forward to a signed copy of that book.
Definitely.
But so let's just start out by saying that I hope you all appreciate that it really doesn't matter who's in the White House, quite honestly. It really matters who controls the Senate. So right now we are in a position where the Republicans, if they maintain the Senate, we are likely to be in a deadlock with respect to legislation. And that would be the best case scenario, quite honestly, is no change is good change. As soon as Congress gets in there and screws things up, that's when it makes it difficult for investors and you and I to do planning. But let's not fool ourselves into thinking that there won't be some dramatic changes with respect to tax legislation, primarily because we have just funded probably one of the biggest bailouts that we have done in a long time, bigger, I almost think, than 2008. And that's the $2 trillion worth of PPP loans that went out to small businesses and large businesses. Somebody's going to have to pay for that. And it is likely going to have to come from tax legislation And that legislation will have to be bipartisan if we have a split House. So one of the things that, so obviously with Biden saying that he's going to reverse all of Trump's tax benefits, well, that's likely to be his wish, but whether he's going to be able to do that or not is another story. But there were many things in the Trump tax cuts that were due to expire in 2026. And, you know, those are on my short list for look out. So one of those certainly has been the qualified business income deduction, a 20% deduction for small businesses, deduction right off the top. So that will likely either be reduced or eliminated. It certainly could be on the chopping block for real estate, because I don't know if you recall, but that one was due to a large lobby by the real estate lobbyists, was actually put in place last minute to allow real estate professionals to actually take that as a deduction. So that could very well be, again, it was scheduled to expire in 2026. It's likely to get rolled back. Another one is depreciation deductions. So regardless of the administration, the bonus depreciation or accelerated depreciation has always been an economic stimulus and usually is favored by the Republicans over the Democrats. So it is likely that that one will be either severely limited or eliminated. And again, to remind you, personal property, business property that is purchased, used in a trade or business can be expensed 100%. So if I buy furniture, fixtures, machinery, or if you do my favorite technique, which is purchase real estate, do a cost segregation study, and allocate a percentage of your purchase price to personal property, that allocation will also qualify for 100% bonus depreciation. So likely to change in 2021. How quickly, I don't know. It's anybody's guess, but could get bipartisan support. So if you are considering purchasing property, purchasing tangible property, good reason to accelerate that deduction into, or accelerate that purchase into 2020. I have a client who is on the verge of purchasing the dealership that he rents from his landlord. And I have encouraged him to get that deal done by the end of this year so he can accelerate the deductions, because fortunately, his business, his RV business, has actually exploded during this COVID time, as have other businesses. I'm ashamed to say that professional services like accounting services, legal services, we've all actually experienced quite a boom in requirement for our services. And again, we are kind of a lagging indicator of economic downturn. So people do, come to us for our services. We'll have to see what's going to happen in 2021.
Yeah.
But, so not all businesses have suffered during this pandemic, but certainly those that have suffered quite a bit.
Absolutely.
So what do we do in this case of uncertainty? So if I were so first of all, not only do we have an election, which makes tax planning very difficult, who's going to be in, what are they going to do, but we have the pandemic on top of that, which makes this just a Herculean event. So what do you do? Well, basic tax planning 101 is typically to accelerate deductions and defer income. And that works very well if you think that rates are going to stay the same or maybe even decline. And that's certainly not the case. As I mentioned, I think that we are going to have to fund this bailout in some way, shape, or form, which means there's going to be an increase in tax rates. Really, Biden has already threatened that he wants to eliminate capital gains preference tax. So right now, you know, you have a capital gain, the maximum that you might pay is 20% or 23.8 if it's a passive investment on the federal side. He wants to eliminate that and be taxed at ordinary income rates for incomes, taxable income over $1 million. And by the way, he also wants to increase the ordinary income rate from now the historic, 35% back up to 39.6%. So it's a double whammy there. So if you believe that rates are going to go up, you actually might want to accelerate to the extent possible income in 2020, not only to preserve a lower tax bracket in 2020, but then also to accelerate the income that's going to be subject to that qualified business income, that 20% deduction that I alluded to earlier that might be going away.
Yeah.
Likewise, yeah.
When you mentioned that, like the income of $1 million and up, is that adjusted income or is that the gross income?
Well, we don't have all the details yet, but I think that he alluded to the fact that if you have $1 million in taxable income, he's going to say you don't need the benefit of the capital gains reduction. So it's the same thing with the QBI deduction. They're talking about maybe not completely eliminating that, but limiting it to those people that have taxable incomes of less than $400,000.
That's another part is like $400,000. Obviously, it is high. If you look at the average of the income in the whole country, but at the same time, again, we don't know 400,000 is that gross or is that adjusted or adjustable income, or is this per household or per person?
Well, the QBI deduction right now is based on 400 in taxable income. So this would be after deduction. But again, we're kind of speculating on a law that we don't know. There's something seems to be fairly magical about the $400,000 taxable income. It seems to kind of permeate a lot of the tax incentives that Trump brought in. So again, I think that will be something that will be at risk, and you just have to watch it. But what I was going to say is that in hand in glove with the accelerating of income, if you think rates are going to go up, you might actually want to defer then your expenses from 2020 into 2021, logic being that those will be worth more in 2021. But of course, a bird in the hand's worth two in the bush. So if you don't want to pay taxes now, accelerate those expenses. So it might be, again, a good planning opportunity, accelerate income, take deductions that you think are going to expire, and certainly keep your options open. So what I've been advising clients to do, again, if they are in the process of selling property and would have the opportunity to close that by the end of this year, I'm encouraging them to do that, because there's another possible chopping block benefit, and that's your 1031 exchanges. Yeah. So Biden, here we go again with 1031s being at risk. As you know, in the last round of legislation, they eliminated the ability to defer gain on personal property, but the real estate lobby was strong enough to preserve it for real estate. So again, it is likely to come up again, but I think that all the arguments that were made to preserve it in the past are still there. Elimination of 1031 would be devastating to the real estate market. I don't need to tell you that. So people would hoard properties. They would not be entering the deals that they're doing if they didn't have the ability to roll that equity over on a tax deferred basis. So
yeah, and that this is also the reason why I think in the real estate industry, real estate market, so many people are kind of like, whoa, what all these tax proposals can affect their ultimately how much money they can get, right? With the whole capital gain tax you had mentioned, and then the 1031 exchange, although They also said that, in the past they have tried to eliminate this 1031 exchange, but it was never passed. But of course, now they want to try it again. So just like go back to what you had mentioned earlier, if the Senate continued to be a Republican majority, then it's likely that that might not affect it. So we'll see. We'll have to see.
Well, I think that will be, that will be deadlocked. I certainly wouldn't, say that 1031s are dead. No, absolutely not. But again, I'd be open to leaving the options open. So that means that if you are going to close on a property, close it by the end of the year. There might be ways to actually then get the benefit of hindsight. So if you were to close on a 1031 exchange property, or a property that was going to be rolled into a 1031 exchange, and then see how things go in the next 180 days, you might be able to leave your options open, because as you know, under a 1031 exchange, you have 45 days to identify and then 180 days to transfer. Well, if I close a deal in 2020 that will be subject to a 1031 exchange, and then for whatever reason, either involuntarily or voluntarily, I terminate that exchange in 2021, that will actually deem to be an installment sale of the property, and the gain could actually be recognized in 2021. It's kind of what we consider in the business to be a poor man's installment sale, so to speak. You basically forced the gain to be recognized in 2021. Now you say, well, that flies in the face of what you just told me. I thought I wanted to take a capital gain in 2020. Well, you can always elect out of the installment sale rules. So with hindsight, you could be looking at a transaction that, well, I had a gain in 2020 and I have a failed exchange. Am I better taking it in 2020 or 2021? And with an election, you could actually probably, make it a 2020 transaction. So again, leaving your options open, I think is a good strategy.
Yeah, I mean, this can get, you also have to look at the whole picture of your financial, obviously that is why we all want to work with a CPA, because sometimes these things can get really complicated, and then you have to have somebody to look over your whole financial. But I want to remind everybody to, if you have questions, type it into the Q&A box. But we do have one question right now. It says, are there any tax requirements to be aware of if paying one of your children to do yard work at one of your rentals, not held as a separate company, total less than $1,000 for the year, and the child is less than 14-year-old? I've read that there isn't any tax withholding if a child is doing work for a parent, but want to confirm. And if the child makes less than the amount required to pay income tax, do they need to be issued a 1099 at all?
Well, that's getting a little specific and in the weeds, I would say. But certainly it is a viable strategy to pay your children to do work. If you do pay them for reasonable compensation, they would have to pick it up as income. All right. Technically, they're employees, although there could be an exemption for that. So you'd want to check with your payroll service and that type of thing. But I would say that in the long run, that's not a big tax planning strategy at this point. But certainly something to consider. So if that person has a specific need, they can certainly email me and we'll get them the answer. I don't know off the top of my head whether a 1099, certainly a 1099 is required for services performed more than $600. So, but then are they really a independent contractor?
Yeah.
They're working for you. So maybe you may have created a situation where you have an employee and now you've got a rat's nest you got to deal with. So I would say you'd want to look at some other alternatives maybe.
Yeah, I agree. Maybe less than $1,000 for the year, maybe not as, doesn't make a big impact.
But I think what a lot of small business owners fail to realize, and I get these questions all the time when I do these seminars. Yeah, what about the business use of my car? I can do that, and that'll give me big deductions and all that. I said, okay, here's the deal. Why are you not paying attention to, say, a profit sharing plan for you? Okay, as a small business owner and a self-employed individual, you have the ability to put away tens of thousands of dollars towards your retirement. Okay. And if you have that ability, I'd rather see you doing that than some of these other, maybe not so beneficial tax planning schemes or strategies. Again, leave your options open. If you put in place before the end of the year a defined benefit plan, let's just say, for you as a self-employed individual, and it is in place, then you have until the filing of your tax return, including extensions, to decide whether or not you want to fund that thing or not, right? So that gives you the benefit, again, of hindsight. Leave your options open. Now, if you wait and don't set up that plan by the end of the year, you still have some options, but they're not as beneficial as having the plan in place. You can do a simple plan, you can do a beefed up, SARSEP, an IRA, something like that. But why not talk to a benefit plan consultant to see if you can be putting away a lot more money than just, $5,000-$6,000 into an IRA. I'd much rather see small business owners doing something like that.
No, when you say small business owners, obviously we have a lot of people who do real estate investments, but then they do have a full-time job. Maybe they have like a small LLC that holds their investment property here in California or out of state. So is it something that applies to them as well?
Well, you have to have self-employment income. So as you're kind of referring to your broker community, you're all self-employed individuals. So looking for ways to reduce your taxable income as a self-employed person. Just like I work for somebody else, I have the luxury to put into a 401k. Well, you have that luxury too, believe it or not, okay, as a self-employed individual. It looks and smells a little different, but it's similar. Same thing with your healthcare benefits. So I think one of the things that small business owners or self-employed individuals fail to realize is the benefits of a health savings account or an HSA. I was just on the phone this morning with actually three brokers who were looking to do some change their accounting over to me. And I said, well, tell me a little bit about your situation. She said, well, we all, of course, we have our, sole proprietor, we report that on our Schedule C, but we also have an S corporation and we have a C corporation. So why in the hell do you have that? Well, my accountant told me that if I have a C corporation, that I can actually deduct the, my medical benefits from the C corporation. And I said, okay, and what's the source of the income for the C corp? Well, I've some of my commissions are going to the C corporation, but then I have to pay that out in the salary to the S corporation, and I have to reimburse the C corporation for the medical expenses that are paid by the S corporation. And then I flow that through to my individual return. And I said, how much taxes are you actually saving? And how much money are you spending on having, two other entities to try to get, a benefit from them? When, in fact, a health savings account, you could have put away $7,500 from a family into a health savings account, and that would be available, after, before tax. You're putting in before tax and getting to use that to pay your medical. So, I mean, there's better ways to skin. I just am amazed at how many schemes are out there that people kind of fall into. They think, well, this is how rich people save taxes. Well, be very careful.
Yeah, absolutely. That sounds extremely complicated. I mean, it really depends on like how much money you're making, what kind of revenue you're bringing in, and how complicated your business is.
Right.
And Jose asked, like, in regards to Prop 19, is there any accounting strategies that could alleviate the burden paying such a large amount to the IRS?
Well, I'm actually glad that you brought up Prop 19, because I was hoping if I could spend a little bit of time on that. So let's agree that is not an income tax savings. Prop 19 was really the companion to Prop 15, which was going to do the split rolls with respect to the property tax assessment for commercial property. It thankfully did not pass. I think people wised up to the fact that would be a huge hit to small business, even though it was initially touted as not, Because what happens in the commercial world is, I don't need to tell you, is that landlords pass property tax increases onto tenants, right?
Yep.
So that just would not, that would not have flown. And I think that the voters saw through that.
Yeah, if I can explain a little bit more, the reason why how the property owners can pass through that tax to the small businesses is that when the small business renting or leasing that commercial space, a lot of times the way is different from residential rent, right? You just pay rent and that's
It's
it.
in the lease.
Yeah, but then like if it's a business leasing a commercial property, a lot of times they have to pay for the property owner's property tax. They have to pay for
Absolutely.
insurance, to pay for all the maintenance. So if their costs go up, of course they're going to pass it down to us, the consumer.
Exactly right. It's contractually in the lease. So that's what I actually had some conversations with landlords who said that if that did pass and I had the ability to pass it through, I wouldn't have the good conscience or even the economic sense to do it because it would bankrupt my tenant.
Yeah.
You know, so I mean, it would have caused problem. But thankfully that didn't pass. But Prop 19 did.
Mhm.
And the reason that Prop 19 passed, I believe, is because again, it was touted as a benefit to seniors. That would expand the ability to make your Prop 13 base portable if you were to go to another county. I think prior to the passage of Prop 19, there was only 5 counties that allowed you to take your property tax base somewhere else on your principal residence. So that looked really good, right? We make that statewide. The problem was that buried in that legislation was the elimination of the ability to transfer a property tax base to your children, okay? And under the old law, you had the ability to transfer a principal residence to your children, and they would step into the shoes of your property tax base as long as you use that property as your principal residence. And there was no restriction on that.
As long as the children use it as a principal residences.
No, that's under the new law. The old law was that the children didn't have to use it as their principal residence.
Right.
Okay. It just had to be used as a principal residence of the parents. And then there was a second transfer exemption which had to deal with other property. And I believe that was $1 million exemption. Again, the assessed value, not fair market value, for other property not used as a principal residence. So that has been completely eliminated.
Mm-hmm.
And you're right, the other one has been preserved, but the children have to use it as their principal residence. Well, heaven's sakes, you know, I've got 2 kids. Okay, I don't think they're going to live together, you know, when I die. So that just causes problems. But anyway, that's it. So the opportunity is for your clients who have other real property that has an assessed Prop 13 assessment base of $1 million or less, and you have the wherewithal, you know, if it's not income producing property and it's not going to turn you into a pauper if you give it to your kids, by all means, give it to your kids now. Because this law doesn't come into effect until February 16th of 2021.
Mm-hmm.
So you have a limited window of opportunity to be able to pass non-principal residence property. You can certainly do it with principal residence, you know, that's fine, but now you're out of a principal residence, aren't you? And I've had some clients do that. I mean, I've got older, very wealthy clients who are actually transferring principal residences to their children now and then renting it back from their children just to preserve the property tax base. But I think the low-hanging fruit here is to look at non-residential property. Again, the threshold is $1 million in assessed value. So I could have a very old, you know, very expensive property right now, or multifamily, have $1 million assessment. It could be worth $5 million. You could transfer that today, and they would preserve that $1 million base. Now, you obviously need to deal with the gift tax consequences that might result as that transfer. But again, here's another planning opportunity. Right now, we all have the ability to transfer $11,580,000 as an individual free of gift tax.
Right.
All right. And guess what? That is set to expire in 2026. And it's supposed to go back to $5 million adjusted for inflation. And guess what Biden wants to do? He wants to lower that below 5 million. We think that it's going to be around 3.5 million. So again, there's another strategy here, which is, looking at your estate planning. I know this doesn't involve income tax.
Right.
It certainly has an effect on, wealth transfer. And if you have the ability to spend that 11,580,000, and by the way, that's per person.
Yeah.
So if I have a couple, you have over 23 million, the ability to transfer $23 million worth of wealth today, and it won't get clawed back. It won't get clawed back to when the exemption goes back, which it certainly is likely to do.
Mm-hmm.
So,
I mean, like some properties, like the one that we were just looking at, for example, Saratoga or Los Altos, easily one of those houses, if their parents pass, they give it to their children, easily worth more than $3 million. So yeah, if that threshold does come down to 3.5, that would affect quite a lot of people.
Yeah. Now there is, there's an old saying that, this doesn't come without a price. And certainly in the estate planning world, if I give property today, I won't get a stepped up basis on my death. See, that's the trade-off. So as we may or may not know, when you die, your property is assessed at its fair market value. And if that value, all your property is assessed at that value. And if that value exceeds the unified credit amount, the exemption amount that's in effect on that day, then the excess over that unified credit amount is taxed at 40% estate tax. So, but the good news, if there is any, is that to the extent that property is included in your estate, you get a stepped up basis. Your heirs get a stepped up basis to the fair market value of the property. So they could go out the next day after your death, sell that property, not have any gain. So there is there's a push me pull you here with respect to planning. You need to, consider the fact that you're giving up the ability to pass property to your children and then receive a stepped up basis, but it might come as a cost, and the cost might be a 40% tax.
Yeah.
So that's what I've been doing for the last 6 months with my clients, is deciding, does it make sense to give it now? Does it make and spend that 11.5 or do it later? Yeah. And you might be in a situation where, if it does go to 5 million, now you've got a couple with $10 million worth of assets and a $10 million exemption. The best case scenario would be that it's included in your estate, but you're not paying a tax because you're below the exemption amount. So that could be the example of the 3 million that you gave if the exemption is 5 million on death. But here's a zinger. Biden wants to do away with the stepped up basis on death.
Oh my God.
So it may not even be an issue there. Now, again, there might be a threshold. It could be for estates over a certain amount, who knows?
Yeah.
But yeah, no, there's some radical changes coming, certainly, potentially.
Yeah.
And if you haven't looked at your estate tax, or your clients haven't looked at their estate planning, again, I know this is supposed to be income tax planning, but I can't ignore,
this is a huge part. I mean, especially considering like how expensive real estate is in our area. So it is something Absolutely. That if you have elderly parents, you got to think about it now and talk to somebody about this and plan way ahead. So I'm so glad Jose brought that up for the Prop 19. And Jay, he said, is moving out of California a good choice to save taxes like Elon Musk?
Well, I got to tell you, so my son-in-law lost his job as a result of COVID. And he was in the middle of selling his house. Just had the grandbaby, and so whose second birthday we just celebrated yesterday, which was great. Got to go to the zoo, but I had to drive all the way to Sacramento because Oakland Zoo was closed and San Francisco was closed. But long story short, he was in the middle of selling his house in Vacaville, and he said, "What do I do?" And I said, well, you know what? You have a very unique opportunity to be not have to be a buyer in a seller's market, right? Because as you just pointed out in the first 15, 20 minutes of this webinar, residential real estate is going up.
Yeah.
And it's certainly going up in the suburbs.
Mm-hmm.
So if you were looking to, trade into another property, a bigger home, that type of thing, you are a buyer in a seller's market. So he had the opportunity, unique opportunity, to be able to sell the house, put the money in the bank, and move in with us. Okay. But now he's looking at moving out of California because it's just going to be impossible to buy something in California. And so where do you think I'm going to go if the grandkid goes? And this is repeating itself among a lot of my friends, especially us that can afford, to sell their house, buy a house for cash in another state. I mean, why wouldn't we? Right. Why wouldn't we necessarily? Of course, housing prices are going up. They're going up in Idaho, where we were looking. They're going up in Seattle. They're going up in Texas. But yes, I would, to answer that person's question, if you sever all ties with California, in other words, if you don't continue to own property in California or work in California, it's a great tax planning strategy.
Yeah.
Because you don't have to pay California taxes. We are probably, one of the highest tax jurisdictions next to New York.
Right.
And God forbid that you wait too long. They're going to tax you for leaving, right? No, that's not a joke. All right. There have been rumblings about California, Governor Newsom actually saying, we're going to tax you if you leave California. Well, I got to tell you, I'm going to get out of here before they do that.
Yeah.
They're going to chase people away.
My philosophy is always that tax is not going to help increasing income. I think that's just like a way to get rid of a lot of people. I grew up in Hong Kong. I came from Hong Kong, and Hong Kong, the highest tax rate is 17% over there. So yeah.
And by the way, they modeled their taxation system after the U.S. taxation system. So when it was, in the old days. So.
All right, we have another question. How much property tax can be tax deductible, federal plus California? And how much?
Depends. Are we talking personal residence?
Yes, personal residence, I believe this one is.
$10,000, that's all you get.
Yeah.
And that includes your state income tax payments too. So you could pay $100,000 in state income taxes, and you could pay $20,000 in, personal residence property taxes, and the most deduction you're going to get is $10,000.
Yeah, so it's all the taxes, like state income tax and property tax, and then total.
That's exactly right.
Yeah.
So and that's federal. California, yay, you still get to deduct, whatever the amount is.
True. Right. And then how much interest on the mortgage can be tax deductible, federal and California? Again,
it depends.
Yeah. And
so the 100,000, so the $1 million mortgage, right? Used to be $1.1 million. So interest on a personal residence, purchase money mortgage up to $1 million. Interest was deductible as an itemized deduction. That has now gone down to $750,000. There is a grandfather clause for existing $1 million mortgages. Again, as long as that $1 million mortgage was used to purchase or improve the residence. If you borrowed money and used it for other purposes, and you're going to be limited to the purchase money part that improved the residence or bought the residence. So be careful on a refi of a grandfathered debt, because that could trigger this limitation. So
that is true. That is true.
Yeah.
Is there any way to get people out who are lying to you and have plenty of money to pay us but never pay except the 25%? I'm not quite sure what this means. Do you?
Is it in the chat?
Yeah, Q&A. Is there any way to get people out who are lying to you and have plenty of money to pay us but never pay except the 25%? Oh, are you talking about 25% tax and they?
I don't understand the lying to you. That must be a There must be a typo. Maybe if that person could
Mm,
clarify that question, maybe we can answer a little bit better.
Yeah, but the 25% kind of triggered me to think about the corporate tax rate. Would
Well,
you like
corporate tax rate 21%.
to?
So that has nothing, I don't know what the 25% tax.
Oh, no, that was just like reminding me of the corporate tax rate is also being proposed to be increased as well under the Biden tax proposal.
Oh, true. But I don't pay too much attention to that because I always tell my clients that a corporation is the most tax efficient way to run a business. So if you are a C corporation running your business, you should not be a C corporation running your business. You need to be an S corporation or operate as a sole proprietorship. So
Yeah, and I'm sure right now a lot of people obviously they're working from home, and so is this a time that they can all get a tax deductible, a write-off on their home office?
not necessarily. You got to be careful with that because first of all, if you're working for somebody else, that's an employee business expense, and employee business expenses were itemized deductions, and that's one of the itemized deductions that were eliminated. So certainly as a self-employed individual, you are already deducting a portion of the use of your personal residence. So that's not a big benefit.
Yeah.
What's happening to a lot of employers is because employees are working from home or working remotely, some employees are moving out of state and still working remotely, right? Well, now that employer could have created a taxable nexus in the state to which the employees have moved. Okay. So now not only have you created a situation where your employees are working remotely, but now you're subject to tax in the state that they are working from. So got to be careful with that.
Yeah. If the company is in California and then they move to, let's say, Texas,
Exactly
then,
right.
yeah.
Well, Texas, yeah. So Texas doesn't have an individual tax, but certainly if you went to Oregon, Idaho, which actually might surprise you, Idaho has a fairly large marginal tax rate. I mean, you hit the highest marginal tax rate, and I know because I looked at this fairly quickly. So you might actually experience a tax increase if you moved out of California and into Idaho, just by virtue of the fact that more of your income is going to be taxed at a albeit lower rate, but more because their threshold for the next tax rate is higher. So yeah, you gotta watch out for that.
Absolutely, absolutely. So this question is, can you offer people money to move, like not force them to move, but give them a choice to get out of all the rent they owe you and just pay them $5,000 to move or whatever they will accept, not evicting, all voluntary. So this is actually more like an eviction attorney question. You definitely need to get an attorney to draft a cash for keys, and making sure that this is not going to come back. And highly recommend that you don't do it yourself, especially in today's environment. There is actually a certain procedure you have to follow. If you need a recommendation of an attorney, let me know. I would definitely be more than happy to share that contact information with you. So Susanna asked, is there a tax for moving out of California?
Not yet.
That's what you were just talking about. This is, Newsom is kind of threatening to tax us, but not yet, and we don't know if it's true or not.
I'm not even sure it would be constitutional, quite honestly, but
yeah,
they're threatening. They're also threatening to bring back the estate tax too.
Oh gosh.
So we talked a little bit about the federal estate tax. There could very well be a California estate tax in the works.
Yeah, but it really shows that, again, show how important it is for us to go out and vote. If it's not because of the vote, imagine if we have more rent control, we have the more tax on the commercial property. It's just, it would get ugly. And sometimes I think politicians, they really do need our help to figure these things out, to let them know that, no, this is going to hurt us more than it's going to benefit us. So, well, now we are close to 5:13. There's just one more question. Do you think we will have another postpone in tax filing date this year due to COVID-19?
Huh. God, I hadn't even thought about that. I certainly hope not, from my perspective. 2020 filing season was the absolute worst one in my 39-year career because everything got pushed to July 15th. So I have not heard anything about that. I don't think that it's in the works, but certainly if we continue to have closures of businesses, ours is not ours is an essential business at this point, but we're not seeing clients in the office. Everything has to be done remotely. So if it got to a point where this virus is so severe that we couldn't have, contact at all with clients, it's likely they could extend it again, but I wouldn't count on it at this point.
Yeah. True. And Margaret asked, do you know if there's rent control in the city of Mill Valley, Marin County? As a matter of fact, so right now we do have a statewide rent control right now, unless like the city has like a more stricter rent control. On top of my head, I don't really know exactly if Mill Valley has any rent control stricter than the statewide rent control. So again, I'll be more than happy to talk to you offline as well regarding that. And next one, I'm from Idaho and all the maskings are up there as well. There's no real escape. It is getting very, very crowded. The locals are all getting pushed out and they're very angry. People are arrested in Idaho for no mask. Moscow, be careful when you're running, where you're running to.
I'm not sure what the Moscow comment, but I can certainly am empathetic to Idaho and the outlying states because absolutely their real estate prices are going through the roof. It actually came off the table as an option for my son-in-law and my daughter. There was actually waiting lines for new home construction.
Wow.
You couldn't get in.
Wow, that's amazing.
Oh, Moscow, Idaho. Thank you. Didn't know there was a Moscow, Idaho. We were looking at Meridian and Eagle, which were outskirts of Boise. But yeah, absolutely out of control.
Yeah, there are lines everywhere with people from Missouri, Chicago, you name it. Amazing.
Yeah. So there is, you're right. There is no escape.
Yeah. And absolutely, this is like people I feel like this is like the biggest movement of all time. Like the whole country, people are just moving around everywhere right now, just because now everything going digital.
Well, the only, unfortunately, what California has going for it is the weather.
Yes. Totally.
So, people born and bred in California, I don't think appreciate the fact that there are some extreme weathers outside of California. So, but unfortunately, we pay for it.
Right.
We absolutely pay for it. I will just say really quickly, S corporation versus C corp versus S corp. So the S corp is a band-aid on poor planning if you put your business in a C corp. So if you have the choice, you should always organize in something other than a corporation, period. Yes, an LLC, either a single member LLC or a partnership, but no, never, 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 ever form a C corporation, and very limited reasons why you should even form an S corporation. Again, it's a band-aid for poor planning with respect to a C corp.
Be sure to talk to people and figure out what is the best. I had people, I had people recommending me to do C corp as well, but then every time I talk to
God, no.
It's like, no, why would you do that? I'm like, I don't know.
Well, it's double tax. It's double tax. So it's a C corp is a separate entity. You're going to pay tax, albeit at a lower rate, 21%. But now when you get the money out, you'll be taxed again.
Yes.
So and the best we're going to get is a dividend of 15%. Well, what's 15 plus 21?
Yeah.
Okay, well, that's 36. and the marginal tax rate for an individual is 35. So you're already out the gate,
And then one of the most common way of investors holding their rental property especially, is LLC. And then I know there are people ask, like, what about if I flip properties? Is LLC still a better vesting than a S corp?
Yes.
Yes. So
let me say it again. Yes.
Better than having personal name, just do LLC. So you have the protection and also good with the tax planning. So, I mean, thank you so much. I know we had so many questions. That was so fun listening to all of that. You covered such wide variety of tax issues here, from estate planning to, real estate investments to income tax. So I want to thank everybody for being here, listening to us, and I hope everyone stays safe. This is our last one for 2020, and I thank you again, Tim, for being here. I'll see you next Tuesday at the installation, listen to you sing and play guitar.
Yes.
And till then, I'll see everybody next year in 2021. Okay, bye.
All right. Take care.
Thank you so much for watching. And don't forget to subscribe to our channel and also come back often to check out our new videos. And also every second Wednesday of the month from 4 to 5 p.m. Pacific time, we will be doing our Bay Area housing market town hall and bring to you a lot of great speakers and to share a lot of real estate information. And I look forward to see you back. Bye.